Introduction of a tax audit. Tax audit is an examination of a taxpayer's business records and financial affairs to ascertain that the right amount of income should be declared and the right amount of debt should be calculated and paid are incurred in accordance with tax laws and regulations. There is two types of audit, which is desk audit and field audit. First, for a desk audit. A desk audit held at the IRBM's office refers to a review process where the Inland Revenue Board of Malaysia (IRBM) examines a taxpayer's submitted documents and records without a physical inspection of a taxpayer's premise. Second, specific desk audit cases can be referred for field audit action. The desk audit serves as a preliminary check, and if serious issues arise, the case can be escalated to a more thorough field audit for further scrutiny. Third, a taxpayer may be called for an interview at IRBM's office if further information is required. During the interview, the taxpayer may be asked to explain specific transactions, provide further documentation, or clarify inconsistencies in their reported income, deductions, or claims. Next, normally concerned with straightforward issues or tax adjustment, which are easily dealt with via correspondence. If any issues during the desk audit cannot be resolved easily through correspondence, the case may then be referred for a more thorough field audit. For the last one, involve checking all information on income and expenses as well as various types of claims made by a taxpayer in his income tax return. The process of reviewing a taxpayer's income tax return involves verifying all reported income, expenses, and claims made for deduction or credits. For the field audit, a field audit is conducted by tax authorities at the taxpayer's premise, such as their business location or residence. It involves a detailed review of financial records, operations, and physical inventory to verify compliance with tax laws. Next, a taxpayer will be giving notice prior to the tax. The notice typically includes details such as the date, time, and purpose of the audit, along with a list of documents or records required for review. Next involves the examination of the taxpayer's business records. This process is conducted at the taxpayer's premise to ensure accuracy and compliance with tax laws. And the last one, a field audit may comprise these following types, depending on its purpose and scope. First, general compliance audit, which reviews the taxpayer's overall compliance with tax laws and regulations. Next, a special audit, conducted to investigate specific concerns like suspected fraud and unusual transaction. And last one, issue-based audit, which focus on particular tax-related matters such as verifying deductions, exemptions, or credit claims. The diagram breaks down the types of field audit into three main categories. So the first category is general compliance audit, that focus on the overall compliance of the taxpayer with tax regulations. Second category is issues-based audit, target specific tax matters such as first explain claim that ensure the accuracy of claim deductions. Capital allowance that verifies compliance with allowances for capital expenditures. Next, incentive reviews eligibility and use of tax incentive. Next, withholding tax checks compliance with withholding tax requirements. For other technical issues, is for covers additional areas needing specialized attention. And the last category is special audits, which is for conducted for specific, often complex scenarios such as first transfer pricing that examines pricing arrangement between related parties. For international client audit, it reviews tax compliance of international clients. Next, electronic trading that focus on online and digital transactions.
The primary objective of a tax audit is to encourage voluntary compliance with tax law and regulation. It aims to ensure a higher tax compliance rate through the self-assessment system. Additionally, tax audits play a crucial role in educating taxpayers, creating awareness about their rights and responsibilities under the provision of the Income Tax Act. Another key objective is to ensure that taxpayers report the correct amount of income and the right amount of tax is paid in accordance with the relevant laws and regulations. There are 6 of audit process, which is audit venue, audit commencement, The visit, examination of records, audit interframe and settlement of audit. First is audit venue. A tax audit is carried out at the IRBM's office, whereas a field audit is carried out at a taxpayer business premise. Where the business premises are not suitable, the taxpayer may suggest a suitable alternative for IRBM's agreement. Next is audit commencement. The audit process begins with the audit commencement, where the selected taxpayer will be notified by the IRBM through a letter of notification. This letter is typically sent 14 days before the audit visit is scheduled. A phone call usually precedes the letter to confirm the audit visit. In some cases, taxpayers may request to defer the audit visit if they have valid reason, such as unavoidable circumstance and reasonable grounds for postponement. The letter includes crucial information such as the records that must be made available for the audit, the specific years of assessment to be audited, the name of the audit officers involved, and the expected audit time frame. The audit commencement stage outlines critical information that the taxpayer will receive to prepare for the audit. This ensures transparency and allows the taxpayer sufficient time to gather the necessary records. The key aspects include the names of audit officers who will conduct the audit, the expected interframe required the records that should be made available for audit, intended date of visit, the years of assessment to be audited. A taxpayer may contact the branch audit manager or branch director of IRBM for the purpose of confirming the audit visit. The visit. An audit visit is only applicable to the field audit. The audit normally starts off with an interview. The purpose of an interview is to enable the audit officers to meet the taxpayer, obtain an overview of the taxpayer's business activity, and to discuss the audit. The taxpayer will be asked to explain his business activities, accounting and record-keeping system. During the audit process, the person responsible for the handling of taxpayers' business records will also be interviewed.
Fourth, it is examination of records. During the course of an audit, the audit officer should be allowed to examine all business records and to inspect stock and equipment physically for verification of the claims made. Second, and issue records pertaining to the years of assessments which are already time-barred will not be examined. In certain circumstances, there may be a need to examine records other than business records, where it involves the audit of sole proprietorships and records. There should be, first, books of account for recording receipts and payments or income and expenditure. Second, invoice, vouchers, receipt and other documents that are required to verify entries recorded in the books of account. Third, documents, objects, material, articles and things which are maintained and kept in the form of electronic medium. Lastly, any other record as may be specified by the GIR. Fifth, it is audit time frames. The time required to complete an on-site examination of record is 1 to 3 days. However, the audit time frame may be extended depending on the following factors. There are two of following factors, which is the size of the business and the complexity of business transactions. Second, the form in which records are kept or the level of compression from the taxpayer. Lastly, the audit timeframes is only applicable to field audit. Lastly, it is settlement of audit. After concluding the audit work, the audit officer will prepare an audit findings report for approval by the branch audit manager. Under certain circumstances, the taxpayer is required to be present at the IRBM office for discussion on the proposed tax adjustments. The audit officer, together with at least senior audit officer, should discuss the proposed adjustments with the taxpayer. The taxpayer, without being called by the RIBM, may be present at IRBM office to seek clarification regarding the process of the audits or to give further information to expedite the settlement of the audit. The taxpayer will be informed of the audit findings, which will cover the following areas. First, audit issue raised. Second, reason and rationale for raising the audit issue. Third, the amount of proposed tax adjustments and the year of assessments involved. In settlement of audit, there is a proposed tax adjustments. If there are tax adjustments to be made, a notification with details of proposed tax adjustments and rationale for making such adjustment will be issued. The taxpayer will be given the opportunity to state his views and give explanation on the audit findings and the proposed tax adjustment forwarded. A taxpayer is allowed 18 days from the date of notification of proposed tax adjustments to file an official objection if he disagrees with the proposed tax adjustments. Additional information and copies of evidence should be provided to support his objection. If no objection is made within 80 days from the date of notification of proposed tax adjustments, the taxpayer shall be deemed to have agreed to the proposed tax adjustments, or when an option is found to have no basis in accordance with the provision of the ITA, the taxpayer will be informed accordingly. Subsequently, a notice of additional assessments with appropriate penalty imposed under subsection 112 subsection 2 or paragraph 44b subsection 6 subsection b or the subsection 112 subsection 3 of the ITA or notification of non-chargeability to tax will be issued. However, if there is no adjustments, a letter will be issued to inform that the audit has been finalized without any adjustments. Audit timeline. The time frame for a settlement of the tax audit should be 90 days in 3 months from the commencement of the audit. IRBM will inform the taxpayer on the progress of the audit in the event that the case needs more than 3 months to be settled. Once the audit case is settled, the audit should not be repeated on the same issue of the same year of assessments. However, if there are new issues to be pursued or new information is received, an audit can be repeated for the same year of assessment.
Next, I will be explaining about seat selection criteria of the tax audit. First is location. The company located in major cities such as Kuala Lumpur, Penang, Johor Bahru and Malacca are selected for the tax audit. This is because the number of listed company and economic activity are well established there. Secondly is specific industry. Special industries such as property developers, contractor and IT are selected for tax audits. Third, contention tax development. The wholly debated contention tax issues such as transfer pricing, withholding tax, inter-restriction, reimbursement allowance and Section 4A rental income may be prioritized for tax audit as judgmental interpreters are involved between the taxpayer, IRB and the courts. For third-party information, IRB will invite on a tax audit another taxpayer if there are reasonable suspicion that such a taxpayer may have been underreporting business income or rental income. This suspicion arises upon examination of the revenue and expenses claimed by the other corresponding taxpayer. Fifth, risk analysis. The RRB compiles statistics on industry average turnover and gross profit across all industry with the help of information technologies. This statistic creates a benchmark for expected financial performance within a specific sector. And the last one is taxpayer previous record of return. A taxpayer who has the habit of late submissions of return or non-submission of return will have a higher risk of being selected for tax audit. RRB explains about right and responsibility of an audit officer. Do's. Audit officers must be professionalism, well-mannered, trustworthy, honest, and act with integrity at all times. They should always be ready to give explanations regarding the objective of the tax audits. Audit officers are expected to be knowledgeable and fair in administering tax law. The don'ts. Audit officers must avoid having any personal or financial interest in the business of a taxpayer being audited. They are prohibited recommending to the taxpayer that a certain tax agents may be appointed as the tax agent for the audit case. And lastly, audit officers must not abuse their position of power while carrying out their duties, as stipulated under Section 118 of the Income Tax Act. Right and responsibility of taxpayer. Thus, taxpayers should be a cooperative, well-mannered, fair, honest, and act with integrity throughout the audit process. They must provide a reasonable facility and assistance to enable the audit officers to carry out their duty effectively. This includes getting access to necessary documents and premises. It is crucial to cooperate response to all queries raised by the audit officers, ensuring that the audit process can proceed smoothly. Taxpayers must not engage in inappropriate behavior such as giving any form of gift to the audit officer or transacting any business with them during the audit process. They should refrain from making any form of payment directly to the audit officer, as all payment must follow officer procedures. It is prohibited to obstruct or hinder the audit officer in the exercise of their functions. Responsibility of tax agents.
Tax agents must be a professional, be fully conversant with the tax law and practices and with their integrity. They also should be honest, trustworthy, transparent and give fully cooperation when dealing with the taxpayer and IBM and adhere to rules and guidelines laid down by the IBRM. They have to refrain from misusing information, acquired or abusing its position as a tax agent for his own personal advantage. The don'ts. Giving wrong advice to taxpayer and collaborating with the taxpayer to avoid paying the correct amount of taxes. Delaying the works of tax audit or acting irresponsibility toward his entrusted duty. And the last one is offering any form of gift to the audit officer.
Understatement of tax. If it is discovered after the commencement and audit that there has been an understatement or omission of income, first, a penalty will be imposed under subsection 113, subsection 2, or paragraph 44, subsection 6, subsection B of the ITA. Second, a penalty rate equal to the amount of tax undercharged 100% accordingly. The Tax Audit Framework 2019 provide that penalty imposed following a tax audit will be 45% on the tax undercharge. Third, IRB has discretion under section 124, subsection 3 to further abate or remit the penalty imposed. Voluntary disclosure. Taxpayers are encouraged to make voluntary disclosure of any underreported or omitted income before a tax audit is conducted. It must be made before the commencement of tax audit. Once the tax audit commencement, voluntary disclosure is not allowed. Rate of penalty under Tax Audit Framework 2019. First, less or equal to 60 days, penalty will be 10%. Second, less than 60 days or less or equal to 6 months, penalty will be 50.5%. Third, more than 6 months, penalty will be 35%. Provision of reasonable facility and assistance. Section 18 and 18, subsection 1A, the taxpayer is obligated to provide reasonable facilities and assistance to IRBM personnel when they are carrying out the field audit in the premise of taxpayer. If failure, the offender may be liable to, first, a fine of 1,000 or 10,000, second, imprisonment for up to 1 year, third, both. Keeping of record. Section 82, subsection 1, subsection A. Every taxpayer carrying on a business shall keep and retain in safe custody sufficient record for as long as 7 years from the end of the year to which the business income or adjusted loss related to Section 82, section 1, section A. If failure, the offender shall be liable to, first, a fine of 300 to 10,000, second, imprisonment for up to 1 year, third, both.